Welcome to the Deep Dive. We're here to take complex information, pull out the key insights, and help you get really well informed fast.
That's the goal. Cut through the noise.
Exactly. And today, we're tackling a topic that affects pretty much everyone. Healthcare. Specifically, one of the absolute giants in the space, UnitedHealth Group or UNH.
A name many will recognize. Definitely.
Yeah, and you might have seen some headlines recently about volatility in big healthcare stocks. UNH itself actually took a pretty significant dip.
That certainly caught the market's attention.
So our mission today is to get behind those headlines. We're digging into a detailed research report on UNH to, extract the essential takeaways.
Right, to understand the why behind the numbers.
We want to help you understand its recent performance, how its huge operations actually work, the challenges it's facing, and maybe surprisingly, what its potential value might actually be.
And just to be clear, this whole conversation is grounded in that deep research report. That's our source material.
Absolutely. So let's explore why UNH stock stumbled and what that might tell us about these massive healthcare businesses overall.
Sounds good. Market reactions can be quick, but the real story often lies deeper. Understanding that underlying why is, well, it's crucial if you want genuine insight.
Okay, so let's start right there with the immediate picture. UNH's Q2 2025 earnings, the results that caused those ripples.
Right.
They reported revenue of $111.62 billion. Now, that's actually up 13% from the year before, and it slightly beat what analysts were expecting.
Yeah, the top line, the revenue, looked pretty solid, which makes the reaction maybe a bit confusing at first glance.
So if revenue was okay, what spooked the market? What was the culprit?
It really came down to the bottom line. The adjusted earnings per share, or EPS, came in at $4.08, and that missed the consensus estimate, which was around $4.45.
Okay.
And the GAAP earnings, the sort of unadjusted profit figure, was $3.74 per share. So a definite miss on profitability.
And why does that happen? What drove the miss?
The company pointed directly to what they called an elevated medical cost trend. Basically, patients are using more healthcare services than they planned for, especially outpatient care and visits to the doctor.
Got it. So more people needing care, that directly hits their profit margins, right?
Exactly. It pushes up their medical care ratio. That's the slice of their premium revenue that goes straight out to pay for medical costs. That ratio jumped to about 84.8% in Q2, up from 84.3% the year before. Not a huge jump numerically, but enough to matter a lot at their scale.
Right. And that squeezed the overall operating margin.
Precisely. It contracted down to about 3.7% from around 4.3% a year ago. So less profit on each dollar of revenue.
And this wasn't just a one-quarter issue, was it? They actually lowered their outlook for the whole year.
That's right. They trimmed their full year 2025 revenue forecast slightly, but the bigger hit was on earnings. They significantly cut their adjusted EPS guidance to at least $16.
Wow, compared to what analysts thought before.
Yeah, analysts were expecting closer to $20.90, so that's a substantial cut. And, the market reacted accordingly. The stock dropped over 5% after that news.
Makes sense.
They said they expect these higher realized and anticipated care trends to continue for the rest of 2025. But, and this is important, they also said they expect earnings growth to resume in 2026.
Okay, so they see it as more of a short-term pressure.
That seems to be the message. It's a distinction worth noting. The profit miss grabbed the headlines, absolutely. But that underlying revenue growth is still there. It shows they can still expand even when costs are tricky.
So short-term margin pain, but maybe not a long-term collapse of the business engine itself.
That's a good way to put it. The capacity to generate revenue seems intact, even if profitability is taking a temporary hit.
Okay, that gives us the immediate picture. But to really understand UNH, we need to look under the hood, right? How does this giant actually work? How does it make money?
Right, because it's not just one thing. UnitedHealth Group basically runs on two massive engines. It's a dual business model.
Two engines. Okay, what are they?
First, you have UnitedHealthcare, or UHC. That's the health insurance side. It brought in about 54% of their revenue in 2024. We're talking almost $300 billion.
Just massive.
Yeah.
And that covers different types of insurance.
Oh, yeah. Everything. Employer plans, individual plans, Medicare, Medicaid, even some global business. Their Medicare and retirement segment alone is enormous. Nearly $140 billion in revenue itself.
Okay, so UHC is the insurance engine. What's the second engine?
That's Optum. This is their health services business. And it's huge, too, about 46% of 2024 revenue, around $253 billion. And it grew faster than the insurance side, up 12% year over year.
Health services. What does that actually include?
Well, Optum itself is kind of like three businesses in one. You've got Optum Health, that's actual care delivery. Think clinics, surgery centers, doctors groups, focusing increasingly on value-based care.
Okay.
Then there's Optum Rx, that's their pharmacy benefit manager, or PBM. Huge scale there, too. They processed something like 1.6 billion prescriptions in 2024.
Wow. And the third part?
Optum Insight. That's the data and tech arm. They provide healthcare analytics, technology platforms, consulting services. They had a big contract backlog, over $32 billion, showing future demand.
So the real power here, as the report suggests, is how these two sides, UHC Insurance and Optum Services, work together, right?
Exactly. That's the core of their strategy. It's called integration. A UHC member might see an Optum doctor, get their prescription filled via Optum Rx, and their care might be managed using Optum Insight data.
So they try to keep the whole healthcare journey sort of within the UNH ecosystem.
Precisely. It helps them manage costs better, potentially coordinate care more effectively, and capture more of the total healthcare spending. It's a big competitive advantage, a strategic moat, really.
Hard for others to replicate that scale and integration.
Very hard. And the scale is just staggering. You mentioned 50 million members. They're also the largest employer of physicians in the U.S., around 400,000 employees total.
That's like the population of a decent-sized city. Just running the company itself must be incredibly complex.
Absolutely. But connecting it back to the big picture, this diversified, integrated model is designed to give them resilience, efficiency, and theoretically, better outcomes. It's fundamental to how they operate.
It sounds like a powerful model, but even giants face challenges. What kind of rapids is UNH navigating right now, and what might be further downstream?
Yeah, no company is immune to risk. We can think about it in terms of short-term headwinds and longer-term, maybe more structural risks.
Okay, let's start with the short-term ones. We already talked about the higher medical costs.
Right. That's number one right now. That surge in care, especially stuff people put off during the pandemic, like seniors getting surgeries, that's hitting their claims costs and margins hard in 24 and 25. But again, they expect that to ease up in 2026.
So potentially temporary. What else in the short term?
Well, there are always regulatory tweaks, recent changes to how Medicare Advantage plans are paid, and states rechecking who's eligible for Medicaid after the pandemic emergency ended. Those things can temporarily affect enrollment numbers or revenue growth.
Like their Medicaid numbers dipped a bit.
Exactly, dropped by about 400,000 in 2024. Also, broader economic factors. If there's a recession, that could hurt their commercial insurance enrollment. Inflation affects their costs too, supplies, labor, drugs.
And there have been some leadership changes too, right? That adds uncertainty.
Yeah, that's definitely a factor. Stephen Hemsley returning as CEO after Andrew Whitty left unexpectedly, plus the tragic death of the UHC CEO, Brian Thompson. Leadership transitions always bring a bit of short-term uncertainty, though Hemsley knows the company inside out, which should help stabilize things.
Okay, those are the near-term bumps. What about the bigger long-term risks? The structural stuff?
Those are probably more significant for the long view. Regulatory and political risk is always there for a company like UNH. It's just part of being the biggest player in U.S. healthcare.
Like talk about Medicare for all.
Exactly. Or serious drug price controls that could really squeeze Optum Rx. Or just generally stricter oversight of Medicare Advantage, where they're huge. There's also ongoing DOJ investigation into some Medicare Advantage payment practices, not just UNH, but the industry. And antitrust scrutiny is real.
Because they're so big and buying up doctor groups and clinics.
Right. Regulators worry about the consolidation of insurance and care delivery under one roof. Could that stifle competition or limit patient choice? That's a constant question they face.
What else long term?
The fundamental issue of healthcare costs in the U.S. If spending keeps rising faster than the economy grows, the pressure from employers, government, everyone to control costs will just become permanent. That could lead to backlash against insurers and PBMs.
And technology. Could they be disrupted?
It's always a risk. Even though UNH invests heavily in tech via Optum Insight, new care models like telehealth advancements or new data platforms could emerge and challenge their position. And finally, managing their massive workforce and relationships with doctors and hospitals, keeping costs down without alienating providers, is a perpetual balancing act.
So while things like the current cost spike are immediate problems, the bigger questions are about how healthcare itself evolves.
Precisely. And UNH's whole integrated strategy is, in many ways, their attempt to navigate and shape that evolution, to prove their value in a system that's under constant pressure to reform.
Okay, let's dig into their spending a bit more. The nuts and bolts. How do their costs break down?
The biggest piece by far is medical claims. That's the money they pay out for members' healthcare. In 2024, it was about 85.5% of their premium revenue.
85 cents of every premium dollar going straight to care.
Pretty much. And these costs are highly variable. If more people get sick or need procedures, these costs go up directly. That's why the recent spike hit their profits so fast.
Right. What about their own operating costs? Running the business.
That's the SG&A, selling, general, and administrative costs. Think salaries for those 400,000 employees, technology systems, rent, marketing, all that. In 2024, it was around 13.2% of revenue.
And are those costs fixed or variable?
They're more fixed, or what you might call step fixed. The cost of their big IT platform doesn't double if they add one more member, right? It scales more slowly.
So as they get bigger, they can spread those fixed costs over more people.
Exactly. That's called fixed cost leverage. And UNH has been pretty good at this. As the membership grew significantly over the last decade or so, their SG&A cost per member actually came down.
That seems like a key advantage of their scale.
It absolutely is. It helps them maintain their margins even when medical costs fluctuate. Like now, they can manage the medical cost side through their provider networks and care management, and they get efficiency on the operating cost side through scale. It's crucial for their resilience.
So who's actually steering this massive ship? Let's talk leadership. There have been some changes, as you mentioned.
Yes, Stephen Hemsley is back in the CEO chair as of mid-2025. He was CEO before, from 2006 to 2017, a period of huge growth, including really building out Optum. He's known for being very operationally focused.
And the CFO.
John Rex has been CFO since 2016, so he provides important continuity through these changes. And at the head of the UnitedHealthcare Insurance Division is Tim Knoll, an internal veteran who took over in January 2025 after the tragic passing of Brian Thompson.
How's their track record generally been? You said the recent earnings miss was rare.
Historically, yes. They've generally had a strong record of execution, often meeting or beating their own forecasts. This recent stumble is definitely an exception rather than the rule.
But there have been some questions, right, about transparency?
There have been. For instance, there's a class action lawsuit from 2025 alleging leadership misled investors about rising costs. And that DOJ antitrust probe we mentioned in the news apparently broke in the media before the company formally disclosed it, and there were reports of some executive stock sales around that time.
Okay. That does raise an eyebrow. How are the leaders incentivized, though? Are their interests aligned with shareholders?
That's a key point. A very large chunk of their pay comes from stock and options. Hemsley's return package, for example, included a huge $60 million stock award that vests over several years, far outweighing his base salary.
So he does well only if the stock price does well over time.
Exactly. It creates strong alignment with long-term shareholder value. And historically, the company has reinvested effectively, making acquisitions like Catamaran that ultimately boosted the share price significantly.
So, despite some recent transparency questions, the structure generally points towards long-term alignment.
Generally, yes. The long tenure of people like Hemsley and Rex, combined with that heavy equity component in their pay, suggests they are deeply invested in the company's long-term success. How they navigate these current challenges, though, will certainly be a major test for them.
Makes sense. Now, who actually owns this giant? And what does the company do with the profits it generates?
Well, the ownership is dominated by big institutions, the huge index fund managers, Vanguard, BlackRock, State Street. Together, they own something like 20% or more.
So, mostly passive investors.
A large chunk is passive, yes. But there are also significant active institutional holders like Capital Group and Fidelity who take a more direct view on the company's strategy and valuation.
And do these shareholders seem supportive of management?
Based on recent votes, yes. At the 2025 annual meeting, for instance, all the directors were re-elected easily. Executive pay was approved by a large margin. A shareholder proposal about limiting executive severance packages was voted down. So it suggests a general level of trust in the current leadership and board.
And how do they return profits to these owners? Dividends, obviously, but anything else?
They are very active with share buybacks alongside the dividend. They bought back around $9 billion worth of shares in 2024 and another $3 billion just in the first quarter of 2025.
So they're buying their own stock back from the market.
Exactly. The goal is partly to offset the new shares created by employee stock options, but also to actively reduce the total number of shares outstanding. Over the last decade, the share count has shrunk by about 9%.
And shrinking the share count makes each remaining share represent a bigger piece of the company, potentially boosting earnings per share.
That's the idea. And it's interesting, management actually increased the buybacks when the stock dipped in early 2025. That can be seen as a signal of confidence that they believe the stock was undervalued at those prices.
So stable institutional ownership, plus a consistent strategy of returning capital through dividends and buybacks. It points to a focus on long-term shareholder value.
That seems to be the case. The buybacks, especially during the dip, suggest a strong internal belief in the company's underlying value.
Okay, let's bring this back to value investing specifically. Have any famous value investors taken a position in UNH? What can their actions tell us?
It's actually quite revealing to look at that. Even Warren Buffett's Berkshire Hathaway dipped their toes in. They bought shares around 2018, maybe averaged around $280 a share.
Oh, interesting. Hold on.
No, they actually sold out by 2020, probably somewhere in the $300. Likely felt it wasn't significantly undervalued anymore at that point.
Okay. What about others known for value?
Well, look at Vulcan Value Partners. They actually sold UNH back in late 2019, also near $280, probably for similar valuation reasons. But here's the fascinating part. They started buying back in late 2024 and again in Q2 2025 when the price fell sharply.
Why? What was their reasoning?
They specifically cited the valuation, saying the PE ratio had fallen to an 11-year low. They saw the price drop as an opportunity.
And any others acting similarly?
Dodge & Cox, another very respected long-term value shop. They've held UNH for a while, and they actually increased their stake in 2025 during the downturn.
Also pointing to valuation.
Yeah, they noted the forward PE was hitting those same 11-year lows, around 13 times expected earnings. So they're not just holding, they're adding, showing real conviction through the negativity.
So the pattern seems to be value investors buy when the market gets pessimistic and the price disconnects from what they see as the long-term value, and maybe trim when it gets expensive.
That's exactly it. Many seem to be holding firm or actively buying around these $280 levels, suggesting they believe the market is overreacting to the short-term earnings pressure. They see the long-term fundamentals as intact.
They're capitalizing on that pessimism.
Seems like it. It shows a deep conviction that the intrinsic value is significantly higher than the current market price.
Okay, then let's try to quantify that. The big so what? Using a method favored by Buffett himself, what could UNH actually be worth?
Right, let's unpack that using a simplified discounted cash flow or DCF approach. We focus on free cash flow or FCF, basically the cash left over for owners after running the business and reinvesting.
And what assumptions do we make?
We'll use a 10% discount rate. That's a common hurdle rate, the minimum return an investor might demand. And we'll look for a margin of safety, say 30% to 50%, as a buffer against being wrong.
Okay. How has their FCF looked historically?
Pretty strong growth. It went from about $8 billion in 2015 up to nearly $26 billion in 2023. That's roughly a 15% compound annual growth rate. It did dip in 2024 down to about $21 billion, reflecting some of those pressures we discussed.
So if we project that forward using different growth rates.
Let's run a few scenarios. First, a conservative one. Let's say FCF only grows at 5% per year for the next 10 years, much slower than history.
Okay, what does that give us?
Even with that slow growth, the calculated intrinsic value comes out around $360 per share. Compared to the current price of, say, $282, that's already a margin of safety of about 22%.
So even conservative assumptions suggest it's undervalued. What about a more average case?
Right. Let's try an average-based scenario. Assume FCF grows at 12% a year for 10 years, closer to their long-term track record, but still below the peak years.
And the value then?
That calculation puts the intrinsic value around $630 per share. Now, compared to $282, you're looking at a margin of safety over 55%. That's substantial. The current price is even below what you'd consider a 50% margin of safety price.
Wow, that's a huge potential gap between price and value.
It is. And just for perspective, an optimistic scenario with 18% growth closer to their best years yields an intrinsic value over $1,000 per share. The current price looks extremely low in that light.
So flipping it around, what kind of return could an investor expect buying at 282%?
Well, if UNH achieves that average 12% FCF growth, the model suggests an expected annual return of around 17.2%. Even if they only hit the conservative 5% growth, the expected return is still about 12.1%.
Which is still above that 10% hurdle rate we talked about.
Exactly. So in Buffett's terms, UNH at $282 really does appear to be selling at a significant discount to intrinsic value, potentially undervalued by 20%, maybe even up to 55% or more, depending on your growth assumptions.
And that's just the numbers. You also have the qualitative strengths, the business moat, the diversification, the dividend growth.
Right. Those factors add confidence. Of course, these estimates hinge on future execution. But UNH's history of adapting, combined with this current valuation, suggests the odds might be tilted in favor of decent returns. even with a healthy margin of safety built in.
Okay, so to wrap up this deep dive, UnitedHealth Group, clearly a healthcare giant, very resilient, very diversified. It's facing some real short-term cost headwinds right now.
That's clear from the recent results and guidance cut.
But its integrated business model, that combination of insurance and services, seems to provide a really strong foundation for the long run.
That integration is key to their competitive advantage and potential resilience.
And despite the stock taking a hit recently, it looks like many experienced value investors see this as a buying opportunity, viewing it as significantly undervalued.
Our own intrinsic value analysis, using that FCF method, seems to back that up, suggesting potentially considerable upside from current levels.
It really makes you think, doesn't it? How short-term market noise, like an earnings miss, can sometimes overshadow the long-term value of a fundamentally strong business.
It's a classic pattern. The immediate news dominates, while the underlying slower-moving value story gets overlooked.
So, the provocative thought for you, the listener, is this. How can you use deep dives like this one to get better at telling the difference between temporary problems and permanent damage, between headwinds and structural shifts?
And what does that mean for how you analyze information, not just in investing, but in any area you're interested in?
It's about trying to turn that flood of information we all face into actual, usable insight. Applying this method, dissecting reports, finding the real nuggets can help you do that.
Building that framework for deeper understanding.
Well, thank you for joining us on this deep dive into UnitedHealth Group.
And just a quick reminder for everyone listening, all the analysis we discussed today is based on publicly available sources. It's for educational purposes only and definitely not investment advice. Remember to do your own research before making any decisions.
Absolutely. Conduct your own due diligence. Thanks again for tuning in.